The breaking point came in November 2022. For months, the cracks in the ice had spread silently beneath the market's surface. The failures of Terra USD, Celsius, and Voyager had weakened the structure, but it still held, just enough for those willing to believe. Then came the collapse of FTX. FTX had been more than an exchange. It was a symbol. With sleek marketing, celebrity endorsements, and a founder lauded as a visionary, it projected an image of solidity in a volatile industry. Its Super Bowl ads promised trust, safety, and a new era for finance. To retail investors, it was a place where their holdings felt secure. To institutional traders, it was a partner in billion-dollar deals. The unraveling was sudden. A leaked balance sheet revealed that much of FTX's assets were tied to its own token, FTT. A house of value built on its own shadow. Withdrawals surged. Liquidity evaporated. Within days, one of the largest and most trusted names in the industry declared bankruptcy. Billions in customer deposits vanished into legal limbo. The shock was immediate, the damage irreversible. The freeze deepened. BlockFi followed FTX into bankruptcy. Smaller exchanges quietly shuttered. Lending desks closed their books. The intricate web of leverage and interconnected obligations snapped strand by strand. Token prices, already battered, plunged again, 70%, 80%, 90% below their peaks. For many coins, there was no recovery, only the long, slow drift into irrelevance. For retail investors, the numbers on their screens told a brutal truth. Portfolios that once held the promise of early retirement or life-changing gains now showed balances smaller than their initial investments. Some had taken out loans to buy in. Others had convinced friends and family to invest alongside them. The weight of those choices was now inescapable. Confidence collapsed like thin ice under too much weight. The cultural conversation shifted overnight. Where once social feeds had been filled with bullish memes and victory screenshots, they now carried stories of loss, regret, and anger. Influencers who had preached by the dip now spoke of hard lessons. The energy that had driven the movement, the belief that crypto was a one-way ascent, was gone. Institutions retreated further. Hedge funds reduced exposure or exited entirely. Venture capital slowed to a trickle. Even long-term believers in blockchain technology began speaking cautiously, framing their optimism in decades, not years. The mood in the markets was heavy, slow, and cold. Trading volumes fell sharply. Prices moved less from enthusiasm and more from necessity. Margin calls, tax loss selling, desperate attempts to salvage liquidity. The weather of wealth had turned to a long, gray season. In this deep freeze, the silence was telling. Exchanges no longer boasted about user growth. Projects that had promised revolutionary breakthroughs went quiet on social media. The NFT boom, once the bright carnival of the crypto world, stood like an abandoned fairground. Its stalls empty, banners faded. And yet, even here, some voices persisted. Analysts drew comparisons to past cycles, arguing that winter was a cleansing force, burning away the excesses and leaving only what was strong enough to endure. Bitcoin's blockchain still ticked on, block after block, unbroken by the human drama surrounding it. Ethereum developers continued to refine the network. But for retail investors whose fortunes had been erased, such endurance felt abstract, a distant comfort to those standing in the cold. The deep freeze was not only financial, it was psychological. It changed how people saw risk, how they spoke about wealth, how they imagined the future of money. Those who had lived through the euphoria now understood the other side of the pendulum, the long, slow arc of loss. By the close of 2022, the market had shrunk to a fraction of its former size. In the eyes of many, the dream of crypto as an unstoppable force had been broken. The question now was not how high it could go, but whether it could survive the thaw.